Good morning, this is Bloomberg Daybreak Europe. Happy Friday, everyone. I'm Tom McKenzie in London. These are the stories that set your agenda. The yen strengthens, breaching 150 against the dollar as traders position for a possible rate hike from the BOJ next month, at the same time as a cut from the Fed. Marine Le Pen sets to push further demands for changes to the French government's budget bill after Prime Minister Michel Barnier dropped plans to raise taxes on electricity in a key concession. We continue to watch movements in French assets through the day. Plus, reports suggest Iran will hold talks on its nuclear program and uranium enrichment plans today with European nations. We're going to be more details on that story shortly. Happy Friday. European stocks then snapped 2 days of losses yesterday to post gains, led by technology. That sector seeing some relief trades filtering through to the upside. Today, though, searching for direction for European markets. Possibly the inflation data out of the euro area later today will provide that direction. German inflation coming in slightly cooler than some had expected, unchanged for the month, suggesting that maybe there is room for the ECB to go again comfortably with another cut. Certainly that is being built into market expectations. On central banks, of course, we can continue to keep an eye around the pricing when it comes to the BOJ, with inflation out of Tokyo coming in hotter than expected. FTSE 100 futures pointing to modest gains of 0.1%. S&P futures, as the US market is to come back after the Thanksgiving holiday, pointing to gains of 0.3% in a shortened day for trading. Nasdaq 100 futures looking to add 89 points. Don't forget, of course, volumes are likely to be light because of the holiday in the US, and as well portfolio repositioning towards the end of the month. Let's flip the board and look cross asset. You're seeing a focus, of course, on the Japanese yen, given the strength that we're coming through on that, crossing through the 150 level, currently at 150.08, though you did get to a 149 level on the Japanese yen, again on hotter than expected inflation out of Tokyo. Markets now pricing a 60% chance the BOJ goes again with another hike for this cycle in December. That is an asset we keep an eye on this morning. Brent trading at $73 a barrel right now. Gold up 0.9%, so a rally in the yellow metal in the session. Let's cross over right now to Avril Hong, standing by for us in Singapore, where there's some optimism filtering through the Asian markets with a focus on China, Avril.
Absolutely, Tom. I mean, we're seeing a gauge of stocks in the region slightly in the green thanks to the surge in Chinese shares today. CSI 300 clocked gains of as much as 2.3% earlier on in the session. And this optimism is surrounding perhaps a softer stance that could come through from China. We see how China is extending tariff waivers for some US goods. There's also a lot of speculation surrounding stimulus, a lot of rumors going on social media to that end. And then some officials are also said to have met to discuss ways to boost consumption. So that's what's driving the sentiment in Chinese markets. But as you mentioned a short while ago, it's really about the yen as well today as it gains. And this is against the backdrop of those Tokyo CPI numbers. We saw it, dollar yen at around the 151.3 level just before the numbers dropped. And then look at where it is now, strongest level against the greenback in about a month. And certainly this 150 is a key level that we've been watching. And of course, Tokyo CPI is closely watched because it is a leading indicator of nationwide trends, and it coming in hotter is something that the BOJ wants to see. That's a prerequisite in order for it to hike. And it's not just about the inflation numbers. If you look at the wage hike prospects, it also looks pretty good, whether you're thinking about what we've heard from the Labour Union of late or the Prime Minister. As for the levels that we've been seeing on dollar yen, we've kind of been here earlier this year. This chart, courtesy of MLive's Mark Cranfield, shows you the slide in dollar yen, so might inform some of the direction that the pair might take in future. And in terms of the option space, if you look at the next big cluster of strikes, it's around the 143.5 level for next week. So that might be another level we watch, Tom.
Avril Hong in Singapore, thank you very much indeed. With optimism coming through for the Chinese markets, expectation, maybe support for the consumer coming through from officials there. And of course, the detail around the Japanese yen and the strength there, on which let's get more context and bring in our Markets Live executive editor, Mark Cudmore, standing by. Mark, what do you make of the moves around the yen? Is this a rational move in terms of yen strength, dollar weakness versus the Japanese yen on stronger inflation out of Tokyo? They go again in December, seems to be the thinking at this point.
I think it is a rational move in the yen, and I do think the BOJ probably goes in December. The pricing in the market at the moment is about 60% that they hike. I think that's probably reasonable pricing. If you forced me to choose, I would say they will hike in December, but it's not high conviction. I think 60-40 is probably a fair way to look at it at the moment. I think that they are very, very desperate to hike given half a chance. They're worried how many more chances they'll get, and given that Tokyo inflation print, it is normally a good leading indicator of the national print. That might give them the cover to kind of hike. And as Avril excellently outlined, it is the wage negotiations for next year also showing early promising signs. So I think it makes sense what we're seeing in the yen rally. The dollar is obviously a very volatile, independent component, but we're seeing a little bit of softness across the board there, helped by what's happening in dollar yen. Where can dollar yen go to if BOJ hike? Well, again, with the disclaimer that the dollar is its own wild component, I can very much see dollar yen getting down to kind of 147 over the next couple of weeks as we see a little bit of retracement in kind of seasonal dollar weakness combined with that potential BOJ hike. But I'm not sure dollar yen goes much lower after that. I don't think this is the start of a long-term trend.
OK, not the start of a long-term trend, but maybe 147, the next level for the Japanese yen. So we'll watch that in the days ahead. Mark, on France, there was a bit of relief around the edges in terms of the sell-off that we've seen in recent days around the sovereign debt of France. A bit of relief yesterday. Yields, I believe, on the benchmark 10-year ended up down around 4 basis points on the day. Do you think that continues? Has the sell-off been overdone in French sovereign debt on the concerns about this budget?
I have no conviction on the short-term path. I have no idea how kind of trading is going to work today or next week. But the more I kind of look at this French situation, I don't see how it doesn't get fixed without going via crisis. It does not sound like the compromises that need to be made between primarily Le Pen's party and Barnier on the budget are going to result in a budget that the market is going to accept as being good enough, which means either they don't get a budget, they don't make those compromises, or they do one that the market doesn't like. Either way, I think the bond market ultimately reacts badly. So I have very low conviction how the next few days goes, how the next week goes. But I do fear that by December or January, we're going to see much more stress level in French bonds. I think it's only after we see that severe stress that we kind of see France getting forced to fix the situation. I think the parallel here, sadly, is going to be like a bit of a slow motion, less dramatic Liz Truss moment for the UK, where it is the market that will force the discipline that the government can't impose on itself.
OK, yeah, we're still haunted by that Liz Truss moment here in the UK, as you well know, Mark. Mark, thank you very much indeed with the context. Of course, the analysis around what we're seeing around the Japanese yen, expectations around the BOJ. 147 on the yen is the call from Mark. And, of course, the view in terms of a potential crisis needed to get to any kind of resolution when it comes to the question around France. Staying on France, Marine Le Pen's national rally is demanding further changes to France's government and the budget bill, at least the budget bill, not the government necessarily, not yet at least, but that 2025 budget bill. Further concessions being demanded then from the kingmaker, essentially, around this issue after Prime Minister Michel Barnier dropped plans to raise taxes on electricity in a key concession to the far right. Let's get more with Bloomberg's Julien Pontus, who joins us out of Paris. Julien, where do we stand in terms of the concessions being derived by the party of Marine Le Pen? How much more the Prime Minister is prepared to give up to get this budget across the line?
Well, as you said, there was a relief rally yesterday on the assumption that it was a breakthrough. Now, as we stand on Friday morning, it's not clear at all how much more Barnier will have to give in, or whether Marine Le Pen is actually ready to make demands that are acceptable for Barnier. So at the moment, we really don't know what's going to happen next week. Will Barnier's government fall or not? There's a few votes in Parliament that will decide that. Truth is in the pudding, as you guys say. At the moment, it's really a roller coaster, and I expect that for financial markets, for French financial markets, there will be quite some volatility because visibility is really not good at the moment.
Yeah, the lack of visibility is clear. Mark Cardmore saying that there may need to be a crisis to kind of force the issue ultimately. Is the national rally, is Marine Le Pen, is she and her team, are they prepared to bring this government down ultimately, or is there a political price for them as well to be paid if that's happened that may constrain them on that front?
Well, a lot of commentators are saying this is a game of chicken between the government and Marine Le Pen. But at the end of the day, for any political party, the end game is to gain power. So what's the best option for her? Is it to appear as a responsible party, to avoid a financial crisis for the country, or is it not to actually have some chaos, have a crisis, and put pressure on Emmanuel Macron to resign? As you know, we can't have general elections until the summer. So it's really a political Game of Thrones. It's very quite hard to read what's in the best interest of Marine Le Pen at the moment. I mean, only she knows that. And whether they can make a compromise, whether it's in her interest to make a compromise. And as it was said earlier, maybe a compromise is too weak. And even if Barnier survives and he has a budget, maybe this in itself will be so weak that it will create so much tension on the bond market that, we'll get a crisis anyways.
Okay, Julien Pontus, thank you very much indeed. Joining us live out of Paris as we continue, of course, to watch the horse trading around this budget and whether or not that government does survive and the budget does get through a crucial week for France next week. Julien, with the context, thank you. Now, to the Middle East, where Iran is expected to hold talks about its nuclear programme with the UK, France and Germany. The European Union will also take part as the mediator at the meeting getting underway in Geneva today. Let's bring in Bloomberg's Patrick Sykes, who's in Istanbul covering this for us. Patrick, what do we know about the talks, what we can expect from them when they get underway later today?
Morning, Tom. Yes, Iran's describing this as a brainstorming session. The idea seems to be to de-escalate after last week's decision at the UN's nuclear watchdog, the IAEA, to censure Iran over its nuclear program. I think what it shows is that Iran is feeling under pressure, right? Both in the region, we've had a year, more of a year now, of direct and indirect conflict with Israel. Looming from the US, we've got an incoming Trump presidency that's surely going to bring an element of that maximum pressure policy that we saw in his first term. And then we had that almost surprise conflict coming from the European side through that censure at the UN's nuclear watchdog. So I think it shows Iran looking to de-escalate where it can, the European side perhaps being the lowest hanging fruit among those crises. And if it can do that, then perhaps it can leverage that to de-escalate in some of those other theatres.
OK, Bloomberg's Patrick Sykes on an Iran that could be looking to de-escalate. Thank you. We appreciate it. Now, linked to this, at least partially, Russian President Vladimir Putin has warned of potential strikes on, quote, decision-making centres in Kyiv using new ballistic missiles in response to Ukraine's attacks using Western weapons. Russia has launched an experimental intermediate-range ballistic missile capable of carrying a nuclear warhead and may fire it again in combat. Of course, the reason I said that they are linked, those two stories, is because Europe is trying to pressure Iran to reduce its military support of Russia in that conflict. Here's what else to be thinking about today. 10 a.m. UK time, we will get the Euro area and Italy November CPI data after the inflation print out of Germany came in unchanged, which was unexpected. 10:30 a.m. UK time, we're going to get the Bank of England's financial stability review. That will be published. We'll break that for you. And today, we're going to get some ECB speakers as well, including De Guindos, Kazaks and Nagel. So a mix in terms of the dovish side to the hawkish side. We'll hear what they have to say after the French central bank governor said that the ECB should certainly be cutting more and potentially more aggressively, given the challenges of that economy. Coming up, Ireland goes to the polls today. We're going to get the latest on the country's snap election live from Dublin. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Irish voters head to the polls today for a snapper general election, which has seen housing and cost of living issues dominate the campaign. For more, we're joined by Bloomberg's Jennifer Dugan in Dublin. Jennifer, why did Simon Harris then call the election early? What was the rationale behind that move?
He came under a lot of pressure from within his party in particular. His party have seen their support rise since he took the position in April. So that was a big part of the motivating factor for that. Also, the main opposition party Sinn Féin have seen their support decrease over the last year. So those are believed to be two of the main factors. Also, the government is in a very lucky position to have a budget surplus. So in October, they were able to offer what has been described as a giveaway budget with a lot of tax cuts and one-off measures. So, I think there was a feeling that they wanted to capitalise on that budget.
Yeah, I mean, I still love the contrast that you have there in Ireland with the giveaway budget as we look to what's happening in France right now, in Germany, in the UK as well, indeed. What have been some of the biggest issues then when it comes to this election in Ireland?
Well, you mentioned housing already. So housing, Ireland has not unusual, but in the fact that it has a housing crisis. But it's the housing crisis here is particularly chronic, and so that's definitely one of the big issues with a lot of debate about how many houses need to be built and suggestions on how to fix that, including even a suggestion to have a new government department, a Department of Infrastructure. Cost of living is also a big issue, and also particularly waiting lists around healthcare. And we've seen politicians, and in particular the Taoiseach Simon Harris, be doorstepped by a lot of voters on the issue of healthcare waiting times and health services. So those, I would say, are probably the three biggest issues.
How has that budget surplus then played into this election? How are the parties toying with the idea of potentially spending more?
Yeah, for sure. It's definitely been a big factor. Politicians in this election in Ireland are definitely in an enviable position in that they have money to back up the promises that they are making. So there's, the budget surplus this year is approximately 25 billion. That's boosted by the 14 billion Apple tax ruling as well. So that's a lot of money to play with. So we've seen a lot of, different solutions to try to fix some of the infrastructure issues that Ireland faces, such as housing, as I mentioned, energy, water, but then also some kind of one-off measures as well. The Taoiseach Simon Harris's party, Fine Gael, have said that they will give €1,000 to every newborn baby. So there's been lots of, sort of innovative and, interesting ways that they have, that politicians have said they're going to, one, fix the problems and B, sort of some nice, put cash in people's pockets.
Okay. So maybe some more incentives for voters out there in the days and weeks ahead, depending, of course, on who wins. Trump obviously looming large generally over kind of global politics. Has Trump come up at all in terms of the potential impact of his administration on the economy of Ireland?
Yeah, for sure. There are a lot of concerns here. Ireland's economy is a very open, globalised economy, but a lot of the budget surplus comes from corporation tax receipts. Those mostly come from US multinational companies in tech and pharma. So with, Trump during his campaign mentioned lowering corporation tax and tariffs. And those are both things that would particularly impact Ireland's economy. Economists and politicians here certainly have raised a lot of concerns. The government parties mentioned this quite a bit during the campaign, and they have talked about ways to try to maybe protect the economy. The government a few months ago started a sovereign wealth fund with some of the corporation tax receipts, so that certainly is one effort that they are taking to try to protect. But yes, it's certainly a big concern here.
OK, really excellent context. Thank you. Jennifer Dugan in Dublin on the elections in Ireland. Coming up, are trucks on track to go green? We're going to take a look at commercial vehicles and climate change. That's coming up next. This is Bloomberg.
Cars are integral to Germany's modern economic and industrial identity, a pop cultural export and political lightning rod. 87-year-old Volkswagen embodies this on a global scale.
It employs 680,000 people around the world. It has dozens of production locations. Millions of people, workers in other industries, are reliant on the business that they get from this company.
It owns several household names. Some of those households are very wealthy indeed, while others descend from VW's principal demographic.
There was a big celebration in Germany to mark the 1 millionth people's car since the war.
The whole idea of the people's car was that every individual in the country would be able to afford one.
Decades later, in 2023, VW's portfolio generated 320 billion euros in sales, equivalent to about 7.5% of Germany's entire GDP from that year.
OK, Bloomberg's Oliver Crook there on VW's woes. You can catch the rest of that documentary online at Bloomberg.com. Now, a lot of focus has gone into cleaning up passenger cars, but 40% of road transport emissions actually come from commercial vehicles. Here to tell us more is Colin McArcher, Head of Clean Tech Transport and Energy Storage at Bloomberg NEF, who joins us from Oslo. Thanks for taking the time. Talk to us about what's happening then in terms of fleets and how they are adjusting around the need for electrification. Which technology is in the lead right now? Is it batteries or hydrogen?
It's definitely batteries, and the first thing you have to look at is it's just that this market has grown really quickly in the last few years. So as you said, we're all very familiar with the passenger car story. 20% of global car sales are now electric. For heavy trucks, it's in the early days. It's still only about 2%, so about 5 years behind where we are in the passenger car cycle, but rising really quickly. And in some countries, like China, you're already up at around 6 or 7%. Some other smaller countries like Norway, you're at 10% of sales. And it really is an electric story so far. There was a lot of talk for a while about how fuel cells were going to play a big role. They are playing a small role, but most of what's happening is you're seeing adoption of battery electric trucks in this segment. And some of them also, it's worth noting, have swappable batteries. Most of them are charged as normal, but some of them are also can also take a swappable battery too.
And clearly, fleet operations are capital intensive. To what extent is cost going to be factored in? I mean, it must be a key factor. Are electric trucks, are they cost competitive yet? How far away are we from being cost competitive if we aren't there yet?
Yeah, what we're seeing is that commercial vehicles in the sort of medium-sized segments in the urban and regional duty cycles, so where they're not doing full long-haul distances yet, those are already reaching cost competitiveness on a total cost of ownership basis. And the commercial vehicle market, the fleet market, is very much determined by total cost rather than upfront or lease prices that you see in the passenger car segment. So we're starting to get there, but some of the other bigger segments like long-haul, heavy-duty trucking, that's going to take a bit longer. You need battery prices to come down a little further, and you need to be in places where electricity prices are relatively low.
Colin, thank you very much indeed. Really interesting breakdown of what's happening in terms of the trucking space, the fleet space around electrification and the progress that's being made. Colin McArcher, Head of Clean Transport and Energy Storage at Bloomberg NEF. Some breaking lines crossing around UniCredit and Crédit Agricole. The CEOs will be meeting in Paris, according to reports from Corriere, the newspaper, of course, over in Italy. This as UniCredit makes that approach, of course, to Banco BPM in its own market and has built out its own stake, of course, in Commerzbank in Germany. And we know that Crédit Agricole also has a stake in Banco BPM in Italy of around 9%. So we watch that story and whether or not we get more details as the two CEOs are reportedly set to meet in Paris. Coming up, will retailers cash in on Black Friday? More on one of the year's busiest shopping days next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. The yen strengthens, breaching 150 against the dollar as traders position for a possible rate hike from the BOJ next month, at the same time as a cut from the Federal Reserve. Michel Barnier's budget battle. The National Rally's Marine Le Pen demands more changes to the French budget after a key concession on electricity taxes. Plus, reports suggest Iran will hold talks on its nuclear program and uranium enrichment plans today with European nations. Checking in on your markets then. European stocks posted a decent day yesterday, snapping 2 days of losses. Today, searching for direction. We have inflation data out of the euro area later today. Maybe that will inform market expectations. FTSE 100 futures currently pointing higher just by 0.1%. S&P futures, as the US returns from that Thanksgiving holiday, pointing to gains of 0.3%. It will be a shortened trading day in the US. Nasdaq 100 futures, though, pointing to a decent session as well, looking to add 94 points. Let's flip the board and look cross-asset then. There's a move into US Treasuries, pretty pronounced. You're seeing Treasuries bid right now, 4.21 currently on the US 10-year. Yields down 4 basis points, so there's a bid for US debt, at least at this point. Of course, there was no trading yesterday in Treasuries. The yen is in focus, 150 currently. The gains coming through a full 1 percentage point versus the US dollar, of course, for the Japanese yen. 150, we'll look to see whether it gets to that 147 level that Mark Cudmore from our MLive team had flagged, with expectations the BOJ could go with another hike in the cycle in December. Brent, $73 a barrel, and gold rallying in the session as well. The yellow metal up 1%. Now, it is Black Friday, one of the busiest shopping days of the year, of course. Retailers in the US and elsewhere hoping to see the most shoppers on record over Thanksgiving weekend. That's stateside. Here in the UK, it's going to be happening as well. I'm joined by Erin Brookes right now, Managing Director at Alvarez and Marsal, for a deep dive in terms of the consumer with a particular lens on the UK this Black Friday, leading into Cyber Monday, of course. Erin, thanks for coming in. What are you looking for? What trends are you expecting to see at a Black Friday this year?
Well, Tom, we had in the UK a very soft October in terms of retail sales. After a quarter of growth, October was very soft, related really to consumer confidence dropping due to concerns about the budget and their own, ability to spend and personal finances. So really going into November with some nervousness about how that start of peak trading was going to look. But what we've seen since the start of November is actually two things. Firstly, consumer confidence has improved about 3 points on the index, so from -21 to -18. And also, the searches for Black Friday deals have been incredibly strong and have started building sooner in November than in previous years. So our prediction is actually that we will end up with a higher degree of search interest in Black Friday deals since 2020. So quite a step up.
And what are you seeing in terms of different categories, where people are leaning into, maybe what they're steering clear of, and whether there's a trading down as well that some had expected to come through this year?
So Black Friday has always been about those big expenditure, like large expenditure pieces, so technology, mobile phones, etc. But given pressure on consumer confidence, relative search interest in those items has come down, though they're still strong. And categories that we're seeing really increasing at the moment are clothing and beauty, which is having a fantastic moment. Tom.
And what about across demographics? Are we seeing a marked change in terms of the spending power of different segments of the population and where they're being drawn, whether or not this is affecting online versus offline? What are you seeing on that front?
So, from a demographic perspective, I think there's concern across the board about expenditure. The budget has been a sort of built to be able to spend a lot of money on government initiatives, and that has hit really everybody across the board, including consumers across the board. I think so. Concerns for everybody, and then in terms of other trends that we're seeing, I think that we're going to see this continued heavy discounting through this week and also up to December, up to Christmas.
And retailers are able to do that whilst protecting margins. I mean, there's always that tension. Obviously, they want to cut the prices, get the consumers into the stores or online. But there's that margin story as well.
There is, and I think there's two things there. There's firstly that retailers will plan Black Friday to build margin in, so they will have special offers on products that they buy, especially to sell in the Black Friday week to attract consumers to their stores, to their websites. On the channel mix point, actually, search interest for Black Friday deals in store has come out quite strongly this year, so that looks to a kind of healthy high street Black Friday, which is good. I think the other thing, Tom, to think about is that retailers are under pressure to shift stock at this heaviest trading part of the year. So managing that discounting, planning that discounting, and making sure that they don't end up in January with a load of inventory that has to go into sale is the way to think about it.
Okay, so that's focus on the here and now of today. As we mentioned, Cyber Monday on Monday, and then pushing out to the rest of the holiday season. How is the rest of the holiday season shaping up, and how much will today be a litmus test?
So our prediction is that today will be very strong. I think what's interesting this year is that Black Friday falls 5 full days after it did last year. So we have a phasing benefit, if you will. November is kind of up to Black Friday is kind of longer than it was last year. And actually, Cyber Monday falling in December tends to be the point where consumers start thinking about really buying gifts for their nearest and dearest. So I think there's a real opportunity for Black Friday to be strong, to pull forward some of that gifting expenditure for December, because we're getting so close to Christmas, especially with online, because consumers won't want to be leaving it to the last minute to hope that, next day delivery is going to deliver and all that sort of stuff.
So as you said, the budget uncertainty is behind us. Consumer sentiment has picked up, at least around the edges. What is your expectation, the data that you see, in terms of how the UK consumer evolves over the next 12 months as we look into 2025?
It's a great question. I think January is going to feel, very tough for the consumer. I think for retail businesses as well. It's hard to see a super positive outlook into 2025, but what I think is wonderful is that the retail executives in the sector in the UK has proved really resilient. They follow the consumer, they adapt, and I think we're going to see another change in consumer behavior as we go into next year, which retail businesses will need to adapt to continue to be successful.
That change in behaviour being a consumer that is putting more scrutiny on its purchases, or?
I think so. What we're hearing at the moment is that because of employers' national insurance contributions, increased requirement from retailers who employ tons of people. It's one of the largest employment sectors in the UK. Retailers have been telling us that they can either, deal with that headwind in terms of cost savings, or pricing is going to need to go up. So I think that creates a bit of nervousness when we just were feeling inflation come off a little bit. And I think that's going to sort of lead us into next year.
Okay, that's an important trend to watch then. Erin Brookes, thank you very much indeed for the analysis around what is happening today, Black Friday, but also pushing out into 2025 as well. Erin Brookes, Managing Director at Alvarez and Marsal. Thank you. Now, some other stories making news this Friday. Romania's top court has ordered a recount of Sunday's first round presidential election following allegations of irregularities and cyber interference. The court claims that ultra-nationalist candidate Calin Georgescu benefited from, quote, massive exposure and preferential treatment on TikTok, breaching electoral laws. TikTok disputes the allegations. Sweden has sent China a formal request for cooperation regarding a commercial Chinese vessel and its potential involvement with severed data cables in the Baltic Sea. The Prime Minister told reporters the request implies no accusation against Beijing. Australia's government has passed a controversial new law banning under-16s from social media. It is one of the toughest crackdowns yet on platforms including Facebook and TikTok, as governments around the globe seek ways to protect children from harmful content online. The ban has sparked criticism, inevitably, from big tech, but also academics who argue it is ineffective, flawed, and may drive kids to darker online spaces. The UK Parliament, meanwhile, is holding a landmark vote on assisted dying today. MPs will decide whether to allow terminally ill people with less than 6 months to live the choice to end their own lives. It will be the first vote on the issue since 2015. Coming up, why our next guest thinks that recent strong growth numbers from the US don't actually tell the full story. We get the view from Sunaina, Sinha, Haldea of Raymond James next. This is Bloomberg. Welcome back. Happy Friday, everyone. European inflation is on the agenda today as we look ahead to November CPI readings from France and Italy. Yesterday, German inflation unexpectedly remained unchanged, supporting arguments for the ECB to keep cutting rates. And certainly that is market expectation, of course, that they will go again with another cut in December. Let's bring in now, for the details, Bloomberg economics editor Zoe Schneeweiss. Zoe, what are the key data points then? Thank you for joining us. What are the key data points to watch for as we track Europe's economy today?
So, as you mentioned, the main number today will be euro area inflation at 11 o'clock local time. That's 10 o'clock in London. Before that, we get the French number, and we also simultaneously, with the euro area number, get the Italian number. Additionally, we also get the ECB's survey of consumer inflation expectations. That's a bit lagging, but still, one of those elements the ECB is looking at is not just what do inflation numbers actually doing, but how do consumers feel about them. So that's an important data point we look at as well.
OK, that's really helpful context, Zoe. What is the latest? I mentioned the ECB and how the markets and how this data will tie into thinking around the ECB. We've been hearing from ECB officials this week. What is the latest thinking in terms of how the ECB is looking ahead as we start to factor in the move that is now being priced in by the markets when it comes to December? Where are we in terms of the future rate path for the ECB?
So just one thing to mention first, the inflation number we see today will be an uptick. That's because of base effects. But the ECB will look through this, and they have clarified that they'll look through this because they've expected this. And inflation still for this quarter will be much weaker than what the ECB predicted in September. Regarding the rate path, you're right. There'll be a rate cut in December. Most policymakers have said rate cuts will be gradual. That suggests a standard 25 basis point cut. However, a few of them have said they may need to go into expansionary territory. That maybe could suggest 50. However, given that there is that whole threat of Trump tariffs coming sometime next year, a gradual approach might win. Overall, the gradual element is one that most policymakers have actually stressed.
OK, they stress the gradual nature of the rate-cutting cycle that is expected into 2025. Really fantastic context. Thank you, Zoe Schneeweiser. We can hear the bells ringing there in the background in Rome. Or is it an alarm? Anyway, the professional nature of Zoe, meaning that she just continues through with the details around what to expect from the data and how that's feeding into expectations around the ECB. Our economics editor, of course, joining us out of Rome. Let's get more in terms of how the markets are positioning around the central banks globally. We'll start with the ECB, but let's bring in Sinha Haldea, Global Head of Private Capital Advisory at Raymond James. We're going to talk earnings, we're going to talk private equity, whether there's dry powder that can be put to play in 2025. But let's start with the central banks then. We heard from De Gallo of France, the central bank governor of France, striking a very dovish tone yesterday. There have been mixed views. We heard from the hawks, we heard from the doves. He was making the case that maybe even the ECB needs to go further than some are expecting, given the weak nature of this European economy. Markets are fully pricing in that you're below 2% in terms of the benchmark rate by, second half of next year? How do you see the rate-cutting cycle evolving for this ECB?
I think the ECB, all things considered, will absolutely lean dovish. I think one of the most concerning data points for me as I look at what's happening in the Eurozone in the past week was the PMI data, which was at close to 48.1 in fact, which shows a contraction. Compare that to the US, Tom, where you have PMIs well north of 50, so 52 heading to 54. That divergence between what's happening in the Eurozone and in the other major markets, US and UK, is starting to become more and more pronounced. So I think the Eurozone ECB folks will absolutely have to get on a more dovish tilt here to try to rectify what's happening in the economy. And if they don't, that divergence will become more and more pronounced, and that's going to have knock-on effects across the economy.
How should investors, how should your clients be thinking about that potential pretty significant policy divergence in 2025? That could be a key theme for these markets then.
It could be an incredibly key theme, but I think in a very positive way, because if the Eurozone is in fact cutting rates, that will make borrowing cheaper in the Eurozone, which then lends itself well to anybody who wants to add leverage for add-on acquisitions, for anyone who's thinking about picking up Eurozone companies that'll impact valuation. Let's not forget that the divergence will impact the euro-dollar, which it has already, as we've seen in dollar strength.
Do you think we get to euro parity?
I think there's a risk of getting to euro parity. I think that's a non-zero risk and an opportunity, depending on which way you're looking at it. So I think all of those things, as you sort of fold in the macro picture here, I'm sure you'll ask me at tariffs at some point, but that also adds to the potential uncertainty, but also opportunity as you think about valuation of companies and assets in Europe versus US.
Well, I will ask you about tariffs because one of the guests on our show earlier this week suggested that, look, maybe something that's being underappreciated by the markets is that corporates in Europe could be pulling forward. There could be a pull forward of orders in preparation for those tariffs. And then, in fact, first quarter numbers could come in, or second quarter numbers could come in pretty strong as orders are pulled forward in anticipation of tariffs. And that, at least in the short to medium term, could benefit European corporates. Is that something that maybe the markets are underappreciating?
I think they're underappreciating that. And they're also underappreciating the fact that every single board that I've sat on, that my clients sit on, had the Trump effect on its agenda for its November or December board meeting. So, there is this rush to get ahead of whatever might be coming down the pike, and that means moving parts of the supply chain, parts of the value-add chain to the U.S., as you saw from Lagarde's statement yesterday. It's moving part of your strategy as to how you operate as a business over to a more U.S.-centric approach to get ahead of what might be coming down the pike. But to get to your broader question on tariffs, I think it's very hard to predict what, when, and how those get implemented. We know that probably China is one of the most highest likelihood places that the Trump tariffs first hit. But what happens in Canada and Mexico, because of how difficult it is to unwind through NAFTA, remains to be determined. Same with Europe. I think, to name a few things, you'll have intense state lobbying. You'll have companies getting ahead of the curve so that what actually are you impacting from tariffs? And then what happens with currency effects, rate effects? There's such a knock-on effect of those tariffs. And when exactly do they come online?
So given all of that complexity, is there a clean Trump tariff trade at this point?
I don't think there's a clean Trump tariff trade anywhere outside of the China market. So I think if you're playing China-US, I think you have probably a much higher read on what and when than what happens in Europe or UK. That all remains to be determined, and I think there's so much uncertainty around that. You kind of play what's happening in York at the company level, at the micro level for the next couple of quarters, and then plan long-term accordingly of making sure that you have access to the US market such that your company's earnings are not impacted.
Well, I want to put a pin in that view around the US. So if we just zero in on what's happening with the US, your view into 2025, do you want to be rotating out of large cap US equities into small caps on expectations that you get tax cuts, on expectations that you get deregulation? How convinced should we be around that theme of rotation into small, mid-sized caps US?
Today, the data around the rotation looks very strong. 70% of the US GDP is centered around the US consumer, and the US consumer is very strong and healthy, as we saw from confidence numbers this week. And we continue to see a very tight labor market, all signs of a very healthy, resilient US economy. So that rotation into small caps, into mid caps, makes a lot of sense today. It's a bet on the US domestic economy, which, as we've just discussed, looks incredibly strong. So today that bet looks good. Including the deregulation, including the loosening up of credit. You know what? The other part of the market that's fascinating to me is the all-time tightening of credit spreads. It's never been as tight as this through April 22. It just goes to show the expectation around the health of the U.S. consumer and its ability and the ability of the companies to borrow remains incredibly bullish.
I want to look back to one of your first answers when it comes to Europe and maybe a pickup in acquisition activity if we get more pronounced rate cuts from the ECB, which is your expectation. We move lower on rates. Talk to us about how much dry powder private equity has on the sidelines right now. What is deal activity going to be looking like in 2025?
I think deal activity is going to pick up meaningfully in 2025. Think about where we've been here, Tom. 2023, the deal activity really came down quite meaningfully because of the increased rate cycles around the world and also because of the macro uncertainty in the first half of 23. Now, deal activity has picked up through 24, but is nowhere near where it could have been or should have been given the election uncertainties in the UK, in US, and what was going to happen with the rate parts. All of that is behind us. What needed to be known is now known for the most part. And so a number of our private equity clients, for example, are telling us that this is the time now for them to get on the front foot when it comes to both buying their main platform acquisitions and for their companies to do add-on acquisitions and looking for where value might lie. And I think that's going to be a very interesting couple of quarters for us. Last thing I'd say is $1.7 trillion is the answer to the amount of dry powder in private market vehicles globally. It's an awful wall of capital with a clock to it that needs to be put to work.
$1.7 trillion of dry powder sitting on the sidelines for now. Maybe it gets put to work in 2025. Really smart, as ever. Sunaina, Haldea on some of these key themes for the markets as we look into next year. Global Head of Private Capital Advisory at Raymond James. Thank you. Let's get back to the central bank action right now, because there's a redhead crossing the terminal around Hungary and the appointment of a new central bank governor. So Viktor Orban, who is, of course, the Prime Minister of Hungary, has tapped his finance chief to be the next governor of the Central Bank of Hungary. And this is the front runner. This person had been the front runner, so it's not a big surprise. Varga, the front runner, will be taking charge then of monetary policy. He has been tapped by Viktor Orban for that role. Currently is the finance chief. So we check in on euro forint. Not a huge move on the back of that appointment, which of course was largely expected. But change at the top of the Central Bank of Hungary. Plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday. I want to give you some context around the CAC 40, which had a pretty decent day on Thursday. But here's the context when you compare it to the performance of the benchmark Stocks 600 in Europe. It is the second worst performance versus that benchmark for the CAC 40 in about a decade, since going back, in fact, to the formation of the euro, because, of course, the concerns about the politics of France, the budget, and we see that wrestle continuing, of course, an evolving story for us. But the pressure has been felt. The CAC 40 is actually down 2.3% in the last 30 days versus a gain of about 0.3, 0.4% for the benchmark. We'll see if that underperformance continues, of course. China is also a factor, given the exposure around autos and luxury and cosmetics. But really, this is about the politics of France. Mark Cudmore of our own live team saying that country will need to face a crisis ultimately before they get that resolved. That's his view. The underperformance of French equities versus their European counterparts. Let's have a quick look right now on the other asset in focus for us today, which is the Japanese yen, breaking through that 150 level. And this is the only G10 currency, by the way, that has outperformed the dollar since the election of President Trump, incoming, of course, President Trump on November the 5th. So the strength coming through again today. The inflation data out of Tokyo coming in hotter than expected, building on those expectations that the BOJ will have the space to hike again at their next meeting in December. Markets now pricing in about a 60% chance odd of that. And referring Mark Cudmore again, once again, just to give him another shout out, he sees 147 in terms of the Japanese yen. So do you see further strength? What is the next level for this Japanese currency that has shown that strength on expectations the BOJ can go again with at least another hike in December? The opening trades is up next. Stay with us. This is Bloomberg.